This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to episode 19 of Value Investing. As I discussed last time, I'm going to make 3 episodes related to bank analysis. And the reason why I'm doing this one is because a lot of investors know how to analyze non-financial companies, but in many cases, they kind of lost in terms of analyzing banks. And as I mentioned last time, there are thousands of public companies in this sector. So you should be able to expand your investment search and should be able to find many good undervalued opportunities in this sector. In the last episode, I discussed how you can analyze deposit structure of a bank and how you can analyze lending practice implemented by a bank. And finally, we also discussed how you can use common equity tier 1 ratio in order to understand the level of capital that the bank set aside in order to absorb losses in the future. In this episode, I'm going to talk about financial statements and how you can analyze them. And I'm going to go into the details of how you can analyze balance sheet and income statement of a bank. And they are quite different from other non-financial entities. Before I start, let me give you a disclaimer that this podcast is for entertainment purpose only. I'm not here to provide any advice to buy or sell certain market securities. It is your responsibility to consult with your investment professional for any investment decisions. If you have any comments or feedback, you can go to valueinvesting.blueberry.net. And I'll make sure that I read your comments. Also, 5-star review always goes a long way wherever you listen to your podcast. So without further delay, let's get started. As I mentioned in this podcast episode, I'm going to talk about balance sheet and income statement analysis. I think you probably know the basics of balance sheet and income statement, but for those of you who are not familiar with these two financial statements, let me just give you the overview of the differences between these financial statements. Balance sheet shows a snapshot of company's assets and liabilities at a given point in time, whereas income statement shows a performance of a company over a certain period of time. So if a company comes out with annual report that contains balance sheet and income statement at the end of the year, that means company is trying to show from the balance sheet how much assets and liabilities the company has at the end of the year. And also the company is trying to show income statement to show how company has performed over the course of that year. So that's the key difference between balance sheet and income statement. For banks, while a profit on the income statement is crucial for investors, it all begins and ends with the balance sheet. When I look at non-financial companies and if I try to analyze them, the first thing that I look at is income statement because that's where the money is. And balance sheet is important in a sense that I look at how much debt they have and equity that they have, but I put more emphasis on income statement. But that's not the way it is when you are trying to analyze banks. So you have to put more emphasis on the balance sheet because that's where you can find a lot of values and that's how you analyze banks. So why don't we get into the details of balance sheet first and then move on to income statement. What I'm going to do is I'm going to put more emphasis on the balance sheet as I mentioned and also put more emphasis within the balance sheet asset side of the balance sheet. If you look at asset side of balance sheet, what you see at the top is something called cash and marketable securities. Every single firm has to have certain cash level in order to sustain their business. They need some liquidity in order to run their business. And this is particularly important for banks because they need certain amount of cash on hand all the time to satisfy customers' withdrawal requests and also to originate new loans. And the cash is invested in marketable securities. However, keep in mind that banks are not in the business of running a hedge fund, which means the banks should not engage in speculative activities such as investing significant amount of cash in stocks and derivatives. As an investor, you have to screen out the banks if they are trying to engage in these kind of speculative activities. By regulation, they're not allowed to do so, but still, you can check their balance sheet easily and see where the bank is investing their cash. Usually what banks do is invest their cash in short-term treasury bonds, bills, and notes. And this is kind of very safe investment from bank side. They also invest cash in riskier, longer-dated mortgage-backed securities. And if you look at the size of the banks, smaller banks tend to be more conservative in terms of investing their cash than large banks because they don't have a lot of resources available in order to analyze these marketable securities. And this is the item at the top. And the next item that I want to get to is loans receivables. And this is probably the most important item on the balance sheet. In the last episode, we already discussed like different types of loans: residential loans, consumer credit loans, auto vehicle loans, business commercial loans, and construction loans. So I'm not going to get into the details of each loan type here again, but what we have to focus on here, loans, is the credit risk associated with these loans. I'm going to cover that in a moment, but let me just cover other items first. The next item that you should be able to see on the balance sheet is called other assets. So these are the assets such as offices, branches, and physical buildings, and so on and so forth. So this item also exists in other non-financial companies, so I'm not going to cover this one in detail here, but the bank has to put this item on the balance sheet. The next item that I want to cover, which is important, is other real estate owned. So in many cases, bank makes loans to individuals just like you and me, and sometimes banks has to take possession of houses if it's residential loans through foreclosure process. This is going to be the main source of issues that bank may have, because what happens is a borrower doesn't typically default on a mortgage when the housing market is strong and home values are rising. So when things are good, they don't really default on their mortgage. But what happens is when recession starts, when things are bad, and a lot of these borrowers start to default on their mortgages all at the same time. That's what happened in 2007 to 2009. Banks have to handle these properties in a kind of different manner compared to other real estate companies, because banks are not in the business of running the real estate portfolio. What they do is they want to get rid of these assets as soon as possible from their balance sheet, because there are just a lot of obligations that come with home ownership. For example, banks have to still pay taxes on their properties, and banks still have to maintain the properties in a good shape, so which will require a lot of resources from the banks. So they don't want to do this job, and they want to get them off from their balance sheet. So we just talked about 4 items on the asset side of the balance sheet: cash and marketable securities, loans, other assets, and finally other real estate owned. And then as I mentioned, what's important when you are trying to analyze asset side of balance sheet is to assess the credit risk associated with these assets. The reason why it's important to assess the credit risk is because it shows how likely a bank will enter FDIC receivership or become insolvent. This is a huge risk for equity investors because banks are, by definition, very highly levered business. So if something goes wrong, then equity portion of the balance sheet is going to be wiped out and equity investors will be left with nothing. So you always have to, as an investor, look at how much credit risk the bank is taking, whether or not the bank is well capitalized. There are two metrics that you have to look at very closely. The first one is non-performing assets, also known as NPAs. And second, non-performing loans, also known as NPLs. Non-performing loans are the loans that are not performing pursuant to its terms. And non-performing assets is an aggregate figure that includes non-performing loans, but also include real estate that the bank owns, usually obtained through foreclosure. A loan generally becomes a non-performing loan when the borrower has stopped making required payments for 90 days or more. So these loans become past due loans. However, you have to keep in mind that not all non-performing loans go to zero for investors. But this metric shows an early warning for future potential problems. So as an investor, you want to see non-performing asset to assets ratio less than 3%. If this ratio is going above 3%, you might be concerned about the bank going insolvent sometime in the future. Let me just try to also mention here two safeguards against the potential losses. The first one that you can look at is something called allowance for loan losses. So when you look at loans receivable, you will also have this item called allowance for loan losses. And banks are required to reserve a portion of their income against future loan losses. And when they do it on the income statement, and income statement item is gonna come into the balance sheet item. So let's say a bank has $100 million loans receivable. And if they believe that $3 million is gonna go bad and go default, then they have to reserve $3 million on their balance sheet through income statement item. And this item is called allowance for loan losses. So you can think of this one as just a reserve the bank set aside in order to absorb losses in the future. So this is the first reserve that the bank set aside. The second safeguard the bank has against the potential loss is the capital. In the last episode, we talked about common equity, tier 1 capital, and tier 1 capital, and total capital. And this is the capital that investors put into the bank in order to absorb some potential losses in the future. If a bank has enough reserve on their balance sheet in order to protect against potential loss, and if a bank has enough capital on their balance sheet, then the bank investors do not have to worry too much about the bank going insolvent in the future. As I mentioned in the last episode, it's all about risk and return, because if you set aside too much capital and too much reserve for future potential loss, then that capital cannot be utilized for lending activities, and it's gonna hinder bank's profit to a certain extent. So bank management team has to assess these things on a regular basis and make sure that they set aside enough reserve, but also not too much that can compromise the profit. So that there's art component into how the bank manages their balance sheet. Okay, so I think we have done enough talking about asset side of the balance sheet. So why don't we switch gears to the right hand side of the balance sheet, which contain liabilities and equity. I don't think I'm going to get into all the details because I discussed customer deposits, but customer deposits are the ones that are main funding source of a bank. So last time we discussed checking accounts, savings accounts, CDs, and brokered deposits. So deposits are the money that bank gathers from individual people who do not need money. And the banks do not have to pay high interest to the customers who are giving money to the banks. The reason why it is so is because FDIC guarantees the money that customers put into the bank, and banks in return have to comply with a lot of regulations. But as I mentioned last time, the broker deposits are worse quality deposits, so you have to stay away from the banks who have a significant portion of broker deposits. When you look at customer deposits, the lower the interest cost, the better. And banks also can have other items on the liability side of the balance sheet. For example, bank can issue their own bonds and raise some funds there. If you look at equity side of the balance sheet, these are the money that investors put it in, and also from retained earnings. But a lot of investors get confused about what this equity represents. It's simply plug-in number. You take asset and minus liabilities. But if you're trying to find out the meaning of this equity item, is basically it's just amount of capital that the bank set aside in order to absorb losses in the future. So there's some complicated method that regulators use in order to calculate common equity, tier 1 capital, and total capital. But you don't have to do that because regulators already have done so for you. So you can just take those ratios and see if the ratios are adequate enough. Okay, so why don't we move on to income statement now. So as I mentioned, income statement shows a performance of a company over a certain period of time, and balance sheet shows a snapshot of a company's assets and liabilities. In terms of income statement, first let's revisit the bank business model. Banks take in deposits from individuals just like you and me and lend those funds out to people, usually business owners, who need money for their business operation. So banks are making interest spread between money that they're getting from individuals and lending the money out to business owners. When a borrower makes a payment on a loan, the interest rate portion of the payment appears on the bank's income statement as interest income. And when you look at interest expense, that's the money banks paid out to depositors just like you and me. So banks can have this net interest income, which is the difference between the amount of interest income the bank receives from borrowers and the amount of interest expense the bank pays to depositors and others. And this is absolute dollar number, so it's not easy to compare one bank against the other. So what you usually look at as an investor is something called net interest margin, expressed as a yield. In that way, banks can be compared with one another. So the higher net interest margin, the better. And this one shows the bank's largest operating endeavor, which is lending activity. One thing also you have to look at from the income statement side is something called provision for loan losses. This item is directly linked to allowance for loan losses that we discussed on the balance sheet side. If the reserve is not enough on the balance sheet, the banks has to set aside more money through this item on the income statement, and it's gonna be shown on the income statement as an expense. So if you try to book provision for loan losses, let's say $10 million, then $10 million is gonna directly hit profit, net income, but at the bottom of the income statement. And that $10 million is going to be added to the reserve. Let's say the bank had $100 million reserve previously, and $10 million will be added, and later reserve will become $110 million. So one thing to keep in mind as an investor is that when analyzing the income statement of a bank, investors should be aware of whether a high income number is primarily driven by releasing the reserve. By the same token, investors should be aware whether a low income number is primarily driven by reserving more funds to the reserve. Here, the management has a lot of discretion in terms of releasing the reserve or building up the reserve, which is going to have a direct impact on the income statement. So what you need to do as an investor is compare the reserve level on the balance sheet against competitors with the same portfolio or similar portfolio composition, and make sure that the management team's assessment of reserve is at appropriate level. Otherwise, at some point in the future, they have to build up more reserve, which is going to hit their income statement, or they may have to release the reserve, which is going to be the positive for net income. So let's move on to the next item, which is non-interest income and non-interest expense. As I mentioned, net interest income and net interest expense are the primary source of bank's business. So when you look at non-interest income, these are the incomes made from non-lending activities, such as various fees that banks charge to their customers. And also they may have some advisory service they can provide to their corporate clients. And finally, non-interest expense are the ones mostly from employee salaries, and they need to spend some amount of money in order to maintain their IT infrastructure. Also, a lot of banks spend tons of money in order to be compliant with a bunch of regulations. These are the expense you can find from non-interest expense. Okay, that's it for today's show. In this episode, we discussed how you can analyze items on the balance sheet and income statement when it comes to analyzing banks. And as I mentioned, this is going to be particularly important for your investment portfolio, since it's going to expand your investment search horizon into the next level. As I mentioned, in the next episode, I'll try to summarize what we have discussed so far: bank business model and financial statement analysis. And finally, we will get to how you can identify good bank investment opportunities in the stock market. I'll just go through step by step how you can do that. But what's important is for you to review all these materials by yourself and try to pick one simple bank in your local area and see if the bank is publicly traded, and if so, you can look at their balance sheet, income statement, and business model, and you can even read shareholder letters from management team just to understand how the bank is operating. I know that this is a lot of information coming to you within 3 episodes. So what I recommend is to read a book that I have used for these 3 episodes. So the book name is The Bank Investor's Handbook. I'm going to put the link in my show notes so that you can go to Amazon and purchase if you're interested in knowing more details about bank analysis. Before I end, if you haven't already done so, please subscribe to my channel, and 5-star review always goes a long way wherever you listen to your podcast. Thank you very much, and see you next time.